The focus of attention is still squarely on industry titans like Nvidia, Nasdaq, NVDA, and other AI-focused chip companies as chip stocks continue to rise. In the midst of this upswing, Bank of America has highlighted Nvidia and another AI chip stock as excellent selections by reiterating its confidence in their future. A number of strong factors have contributed to the recent spike in AI chip stocks. The SOX ETF increased by 57.75% in the past year, highlighting how hot the semiconductor market is right now, especially for companies who are profiting from the artificial intelligence boom. The share prices of companies like Advanced Micro Devices, Nasdaq AMD, and NVIDIA have surged dramatically. For instance, NVDA has gained a whopping 236.8% over the last 12 months, while AMD has increased by 25% in 2024 and more than 87% in the previous 12 months. Melius analysts maintained a buy rating on AMD and increased the price target to $265 from $192 in a recent report. Investors were cautioned not to sell their Nvidia shares despite the fact that they said AMD's stock was looking like the Nvidia Mini. Given that Nvidia is the industry leader and AMD has a higher TAM, the company stated that it does not anticipate AMD having a negative effect on Nvidia's momentum. Nvidia's market expansion and increased awareness continue to benefit AMD and all other parties involved. Naturally, the surge in demand for semiconductor chips around the world, which are necessary to run AI models and applications, is the driving force behind the rise in many chip stocks. The increase in AI chip stocks can be ascribed to the ongoing progress and integration of AI technology throughout diverse industries. The strong recent advance in chip stocks can be attributed to investor confidence in the sector due to the development of AI applications and their exceptional growth potential. This week, Bank of America analysts stated in a letter to clients that their top choices in the U.S. semiconductor market are Nvidia and Broadcom Inc., Nasdaq AVGO. They noted that NVDA and AVGO are leading a generational change in the adoption of accelerated/AI servers. However, we think that the market for accelerators is about to double to $200 billion over the next 3 years, which might lead to unpredictable but lucrative chances among the number 2 providers, such as buy-rated. More stock volatility is to be expected because each junior samurai trades intriguingly at a valuation premium to its corresponding leader, they continued. However, the junior can probably keep carving out a lucrative niche as long as the leader increases the market TAM. As Managing Director and Global Head of Technical Strategy at Fundstrat Global Advisors, Mark Newton provides takeaways from the first quarter. We are examining technical trends from the last few months and where there might be possibilities ahead. He says, we've made progress for the past 5 months. We've had an amazing quarter. S&P has increased by about 10%, making this the 12th strong quarter in nearly 75 years. It's an impressive quarter, he continues. Over the winter, we saw gains for 4 months in a row to begin with, and now we have 5. 3 things, in my opinion, are crucial for investors to understand. Firstly, the rally hasn't just been focused on technology. As we all know, tech has underperformed over the past month. Secondly, we've seen this spread to industries other than finance, such as industrials and discretionary. Lastly, we're seeing material and energy start to outperform, indicating that the market has become much more diversified. Regarding your second points about Apple, the stock market hasn't exactly witnessed indiscriminate buying. There have been some notable laggards, like Apple and stocks like Tesla, so I don't think we've reached a point where we're witnessing wild speculation or complacency just yet. Thirdly, it might be argued that the stock market is not expensive either. The Nasdaq's forward PE is currently at about 21, which is lower what it was in the pre-COVID years of 2019 and 2020 and far lower than it was in the early 2000s, when the PEs were up almost above 70. If anything, then the stocks that have dominated the indices are the ones in which many investors have invested. They have produced many excellent gains for us and are also the ones making all the money, so that's a positive thing. Another name that is very significant to the market is Nvidia. What a move for that brand. Mark says, just wondering what Nvidia's technical charts are trying to tell you. We've noticed a slight slowdown in Nvidia over the past few weeks, but technically speaking, we've got that even at current levels, which are at about 903. I don't believe that's really all that significant. The stock has increased 400 points, or more than 80%, since its beginning. I believe that this is just a temporary period of consolidation and that tech will continue to rise. It was literally just 3 months ago, so you know, it's been a rocket ship, parabolic, and has given us nearly 35% of the gains in the Nasdaq and about 25% of the S&P. Additionally, it represents a decent earnings chunk for the S&P and the Nasdaq. We are aware that inflation is currently declining and that Powell's comments were extremely dovish. Since the FED is now in line with the dot plot, rates should begin to decline, which will only support technology and large-cap growth. I still see Nvidia as being pretty optimistic because I see it returning to this past Monday's highs, which are roughly 968 and above that. That should raise the stock to somewhere between 1050 and 1100 by the middle of April. Selectivity pays off, but overall the sector has a lot of stocks that are performing exceptionally well. For example, if you look at semi and semi-cap, which is the best performing level 2 industry group of the S&P of 25 groups, it is up roughly 36% for the quarter, more than twice as much as the next best performer. You know, I like a lot of these stocks, but until we get proof of very technical trends breaking, well, it doesn't make sense to argue or resist this trend. Given that they are overbought, they ought to decline. There are continuous supply and demand limitations in the story, so that's undoubtedly a very bullish element. Furthermore, based on my own cycle research, it appears like Tesla is about to reach its bottom. I do, however, have some encouraging remarks for investors. If anything, we know that supply constraints on many of these companies have led these stocks higher, and that doesn't appear to be ending anytime soon. Although the technical trends appear to be rather unfavorable, I believe it is worthwhile to try to identify minor opportunities for the stock to trade. If it can get above the close of 183, which is where it is currently trading, the near-term trend will likely turn much more positively. That should push it up to 220 and probably 245, so I believe we're getting very close. As you noted, sentiment is terrible, and there are many reasons why people might give up now that the stock has declined over the past few years. We all respect Elon Musk's brilliance. I believe that the stock is only waiting for the right moment to start working, since it appears to be getting near to that point. In conclusion, Nvidia and Broadcom emerge as top picks recommended by BofA, representing promising opportunities for investors looking to capitalize on the tech industry's growth. With their strong financial performance, innovative technologies, and strategic market positions, these companies continue to attract attention from both investors and analysts alike. As always, staying informed and conducting thorough research is essential for making informed investment decisions. Be sure to like, share, and subscribe to Investing Tutorial for more insightful content on investing strategies, market analysis, and stock recommendations. Together, let's navigate the world of investing and build a brighter financial future.